Perfect. All right, guys. So retail sales just missed, and it was a big miss. It was like 1.1% miss. So that was not good. So retail sales was negative 0.9 on expectations of 0.2. So how you doing? That one hurts. And the prior was revised down 0.3 as well. At the headline, that was a headline at the core. The prior was revised lower. I'm just waiting for the little pop up, down 0.4, and then the core missed expectations by 1.1%. So those are solid misses in retail sales. And what we've seen is the dollar come off quite sharply, especially against the yen. And that's been the trade here in the last 24 to 48 hours is buying of the yen. Yen buying is pretty key in high volatile markets, especially in high volatile markets that also is accompanied by stock markets pointing lower. And I mean, that's kind of a redundant statement because usually volatility is high when markets are pointing lower. And so this is right here. This seems to be the best currency pair that is reflecting the current environment here, what's going on with stocks, commodities, as well as bonds. We'll get into that. Let's just take a look at what stock futures did in reaction to that number. That was a bad number. So let me just get this going here. Okay, S&P futures, wow, yeah, that hurts. So futures this is a 30-minute chart. Let's get on to a 15-minute. Futures at 8:30 were right around 2,000. And we've dropped right now a net of 10 handles, but we've done a total of 15 handle drop from retail sales. So that is just a nasty drop. And just to kind of drive that point home, as I like to start off most of the webinars, is to look at what's happening on the intermarket picture. Okay. USD, JPY, that's what I need. And if we just overlay dollar yen on top of the futures, S&P futures, I think you will see what I'm talking about. Wow, right? Unbelievable. And what's happening is I love this. I love the correlation stuff because correlations, when they're running high, they actually tend to increase the efficiency or increase the accuracy of your technical analysis style. Okay, if you're just doing technical analysis on one chart, okay, I have a pretty good idea. This looks to be kind of a fib retracement from this high. Looks to be about a 38%, and then from this high looks to be about a 78.6%. Fine, whatever it is. Great, you're doing your analysis. But then if you can kind of corroborate that story with a correlated market and a technical setup and a similar market, then that really increases your odds of success. And I find that some of the best trades that I've done over my career trading for myself, for the hedge fund, for the prop firm I used to trade for, was in high volatile markets. So this is the time that you got to stand up and be aggressive, because I think when markets are highly volatile, highly emotional like this, that's when people are trading by the seat of their pants. People are just going crazy in here. And in those times, that's just basically crowd following psychology is driving the market prices. They're just reacting to the next tape bomb that hits the market, and people just tend to make the same emotional crowd following moves in the market, and that creates patterns that we can very easily see as technical traders. And that's why I think that over my career I've done much better in volatile markets than chop low volatile markets that aren't really inspired. Okay, so that is dollar yen and the S&P certainly moving lower. Let's just keep building this intermarket picture, and let's see what bonds did following that report. Oh yeah. So bonds really moving higher. So bonds, stocks trading pretty inverse to one another. And just to confirm that, here's a little trick on MotiveWave. The when you're comparing two markets that are trading inverse, I kind of think of it as comparing apples to oranges. They're similar, but you can't really get the real feel of how they're similar until you kind of put them in the same skin. That's a horrible example, but I think you know where I'm going with that. So the way I like to compare apples to apples is just to invert one of the markets, and then you can really see how tight these two are or how closely these two are trading. And you can see that these stocks and bond markets are trading very closely. Correlations are extremely high. And basically what I did, guys, is I took a 30-year bond chart and flipped it upside down and just basically made it a 30-year bond yield, a 24-hour market, 30-year bond yield. So those guys are trading quite well together. So bonds continue to push higher, so I'll look at that chart. Dollar yen to the downside. And what's interesting is for the first time in a while, actually, this move just in the last 24 hours is not based on commodities. This is other stuff. Commodities have certainly been moving quite a bit, but they're taking a little bit of a break. So let's add crude oil on here. And you can see crude oil was tracking, and I'm just kind of using my eyeball here, just looking at the correlations. You train your eye long enough and you can pick up when markets are trading together. Real-time correlation here with stocks. But what's interesting is now crude oil is not breaking to a new low. And crude oil was certainly trading very well with stocks, not here. I mean, we did get a little bump up there in crude oil. I mean, not to the same degree, but we got a rally in crude, rally in stocks. Stocks sold off real hard on that reversal yesterday, which we'll talk about, which was massive. But what's interesting is now crude oil is not breaking to new lows. Okay, so the lows were set back on the 13th, which was yesterday. Crude's off the lows where stocks have made a new low. So you got to ask yourself, is the crude oil story kind of baked into the market right now? And the market's now focusing on the fact that economic data has not been stellar. I mean, the jobs report last week was good. I mean, the wage growth continues to be a real problem, and markets don't love that. I mean, you can keep adding jobs, but if you're just not paying people more, that money's not going to go back into the economy. So perhaps stocks and bonds are now focusing on the data, and this morning's retail sales number really didn't help things at all. So my point is maybe the stock market is going to latch on to something other than falling crude oil to continue to push lower. Okay. One of the best trades right now, and my background, I did trade for an FX hedge fund and a senior technical analyst for Forex.com on Wall Street. So I've got a lot of background in currencies, but the dollar yen in this situation, this is like the perfect storm for dollar yen. You've got bonds through the highs. Nobody's expecting bonds to continue to rally, and they just ripped higher. Bonds trade very well in an inverse relationship to dollar yen. So if we just take dollar yen and bond market, again, we're comparing apples to oranges here. If you just flip dollar yen upside down and compare apples to apples, you will see that these guys are very tightly correlated. I mean, guys, this correlations are awesome. It helps. It makes the market make sense. It puts the market into gives you clarity. You understand why things are happening. I think if you understand why moves are happening, that gives you conviction to not only pull the trigger at the perfect time in a trade, but stay in the trade when it's working, when you have intermarket confirmation. So intermarket analysis is a key to our trading analysis. Okay, and Tony at MotiveWave has done such a nice job giving us the tools that we need to do intermarket analysis. So that's the intermarket picture. And in such volatile times right now, you don't need to be so much of a stock picker. When vol is very high like this, volatility and volume is very high, you can just go ahead and trade the major markets. Trade the SPY, the IWM, QQQ, TLT, GLD, USO, UUP. Just trade the ETFs on top of these markets. If you want to trade the spot FX market, great, no problem. But you can just go ahead and trade the indexes rather than trying to stock pick it. All right, so that's the intermarket flow. Let's take a look at the S&Ps. And kind of show you the technical position there. So yesterday, we've been tracking the S&P, and I kind of did something fun. Let me just show you the members area here, and I'm going to pat myself on the back for just about 8 seconds, and I'll be over it. So we've been tracking the S&P. So this is the members area in our site, and this was S&P on the 3rd, or sorry, on the 12th. So we're just looking for wave 1 high, red A, a triangle consolidation in B. We're looking for a little rally up in E to then fail and give us a push down. So that was 2 days ago. This was yesterday at the open. We did get the successful test at the D wave low, rallied up in E. I left for CNBC yesterday and left our customers saying I expect resistance into the 2050 area. Had to go, was gone for most of the day on TV, which is unfortunate, and then we got the very sharp reversal. So the market's very highly volatile. I mean, we have some massive intraday price swings here. I mean, this move is from 2,100 down to 2,000. So you have a 100 S&P point move in a week, and you've got almost an 80-point move up, 50 or 60 point move down, 40 point move up. I mean, these are big moves, but they're tracing perfectly within a B wave triangle. And I'm thinking that we are now in 5 waves lower for C, targeting 1950 to 1920. So if the stock market's going to continue to go down, as we just looked at in terms of intermarket analysis, dollar yen is a great way to do it. If you don't trade spot FX, go right to the FXY. If dollar yen goes down, FXY ETF goes up. So you want to be long the FXY while the S&P pushes to the downside. That is trading like a macro hedge fund with intermarket analysis and Elliott Wave behind you. So FXY, I think, is looking pretty good. Futures, not going to give us much of a chance to get in here because with, what do we have, 30 minutes to go ahead of the New York Open. I was hoping for a rally back in wave 2 into 2033, 2038 to get short, but now retail sales just kind of crushed that. We're going to open down a solid percent. So the futures are down, 25 handles pre-market. So wherever fair value is, I mean, we should actually open below the wave 1 low. So that might have been all of wave 2 right there. Okay, that's pretty amazing. So based on the assumption that the wave 2 high was in, it was just a very shallow 38%. We now have to go to work figuring out how far wave 3 would go. And the way we do this is I do it the same way every single time. When you have this kind of situation, if you think B wave correction's over and we are moving into a C wave, here, let me just pull this off to the side a little bit. There we go. So here's the 30-minute chart, and here's the 3-hour. If you think we're moving lower in a C wave, all right, 5 waves down, and the prior was a 5-wave move, okay, A was a 5, B, whatever it is, that means C is going to be a 5-wave move, okay? So if you have the first push down in the C wave, rally back in 2, you need to set your minimum expectations for your 3rd wave decline. And the way you do that, using MotiveWave, you just click on the label you want to, the degree that you want to study, and you right-click, ratio analysis, and then I immediately go down to 3v1. And what I'll do is find out where the 100% 3v1 level is. That is your minimum target. And what I like to do with this is just right on it. I mean, I run the research business, and I actually have to do this for hundreds of clients around the world. But I love doing it for myself. Just make notes on your chart. He's got a great lineup of tools you can use. Minimum target. Put reminders on. It's like putting sticky notes all over your charts, and it reminds you to trade your plan. It's so amazing how ADD we are as a culture, and especially with all the technology that we have and all the other stuff down on your toolbar there on your computer that kind of distracts you from your trading plan. So do everything you can to just lay out the likely path of the trade. So I'll just write right here, minimum target 1980. Okay, below there we have the ideal target And the reason I'm calling that the minimum is in a third wave, it should go at least as long as the first wave. So 100% is 1980. So 100% of wave 1 in ongoing wave 3 is 1980. 1.618 is your ideal, and that's why it's color-coded green, is on in 1951. So let's just write it right on there, 1951. That actually needs to change to 1272. That's kind of an intermediate target there. But that's going to be the focus level, right? And on the bounce, which I'd be shocked if we got one, but in this market, you never know, anything's possible. We really shouldn't get above the 786 retracement of the wave 1. So that's all the way up here. So that's at 2046. I'm not even going to put it up there because, well, I guess I should. Okay, let's just do this. Must hold resistance. Okay, so that's that. So that's the S&P, and that's the plan. You know, we have some pretty high volatility levels. Let's take a look at the VIX, and this is going to help us set up the plan in the trade. The VIX, I remember last night going over this with customers. The VIX is not actually as high as you think it would be with all this volatility. Okay, I'm sure it's taking a long time to load. The volatility is not as high as you'd think. There's been so many back and forth swings, you'd expect the VIX to be higher. But remember, the VIX really only gets a bid when stock prices really break down, and we haven't seen a real breakdown yet until probably this morning. We've seen a lot of back and forth. If you go back and look at it, I mean, this was the same price December 12th, you know, back in the S&P. This is the same S&P price as November 3rd. I mean, basically, we're unchanged in the last 3 months. You know, we've in the S&P here in red, we've traded all the way up to 2080, you know, down to 1974, 1996, 2062. So we've just done a lot of back and forth, and it's causing investor anxiety. You know, people hate watching their portfolios go up and down, where you and I as traders love it. But it's not really putting a huge bid into volatility. And this is what one of the main ideas we had with our premium video was we want to be long volatility, because if this Elliott Wave pattern that we just worked out in the S&P plays out, this VIX is going to break through this 22 area resistance and head back up towards the highs. So long VIX calls is something I'm very much interested in. How would we structure that? Well, let's just do the Elliott Wave analysis that we did before. Okay, I think it's going to be A, should be B, and should be C. Now here's how you structure options trades using Elliott and Fib. All right, we want to study this wave, A wave, compared to C wave. I want to know how it compares in both price and time, because that's going to help us figure out how far the C wave should last. So the first thing you do is you click on the degree you want to study, you right click, ratio analysis, C versus A. Okay, so now we have 0.618 of A versus C, and we have 100% of A versus C. Okay, that's not enough, so I want to right click and pin it. The next study I want to do is we've just studied A wave compared to C wave. Now I want to study B wave compared to C wave. So you right click, ratio analysis, and then you want to go C versus B. So you're comparing C versus A and C versus B, and you're trying to build a fib zone. Okay. So the 100% C versus B basically means this is 100% retracement right here. If we go up to the 1272, that's at 2510. All right. So this is kind of a minor zone here. And then we also have an old high here in the VIX at 25. Okay. So now we have 3 levels. We have these 2 green levels, which are ideal, and we have an old technical high at 25.15. So I'm liking this as the intermediate target and this as the primary target, up around 25 to 27. Now, if we want to do this in options, you also have to figure out how far out we should go. So if we right click, I just want to do the exact same study that I did, not with price, but with time. So we go time analysis. Let me do it up here. Right click time analysis, C versus A. We have some interesting levels. 100% would be January 15th. That's tomorrow. 1.618 is going to be January 20th, which is next week. All right. So let's just pin that. And then I also want to do time analysis of B and C. Okay, that points to a nearby level. And the last one I want to do, and I'm getting into some a little bit more advanced stuff here, C plus A of B. And I'm just looking for clustering of time. So it really looks like, I mean, it doesn't look like we have that much time for this to go. I mean, it really should go out into next week. So, you know, the whole thing is you don't want to buy options that are too far out. You don't want to pay for too much time. So, you know, I'm actually looking at doing like a call debit spread in the VIX. Just going, I don't want to go 1 week out. I want to give myself an extra week. So we'll go 2 weekly strikes out and do something like 21. I'll probably do like looking to do like a 21-25 call spread. You could get aggressive and sell 26 or 27s. You're probably not going to get that much above the old high here in terms of premium. But just try to capture this move up to the 1272. So I do like a 21-25 call spread 2 weeks out. So that's a trade I'm going to look to do with clients. Okay, that's VIX. All right, so from there, let's take a look at crude, and then I want to do copper quick. Copper's really breaking down. Crude oil is I don't know what crude oil is doing, to be honest with you. It's trading extremely well right now. With it was trading extremely well back up here on January 8th into the 11th. And what we're tracking here on the 3 hour is we're looking at wave 1, wave 2, wave 3, wave 4, and we're working off the final of wave 4 and 5 to complete what I think is a longer term low in crude. It's not the low, guys, but I do think we're going to get down towards 44 to 43 FSZ, fib support zone. All these Fibonacci support levels that are ratios of all of the waves up here point towards 42.30 to 44. So right around the 43 level. I think we have a blue 4 up with one more push down. Now talking about correlations, this is really cool, I think at least. If we go over to the dollar, let me bring over, this is my FX workspace. I'm just going to pop this chart out. Okay, just slide this over, shrink him up. So this is crude on the 3 hour. Here's euro dollar on the 3 hour. Here we get rid of this. This is our buy sell system. Options greater than 3 hours. Apply. Okay. All right. So here's euro declining, and what I see is black circle 1, 2. Black circle 3, 4, and we're looking for one more move down in 5. Let me hide all degrees and below. And there's a new feature on MotiveWave, which I'm very happy to. There we go. So we're looking at black circle 1, 2, 3, 4, down in 5. Look over here on crude oil. I'm going to put the two charts next to each other. Black circle 1, 2, 3, 4. We failed right around this January 8th to January 11th high in crude oil. We failed in this January 8th to January 11th high in euro dollar. It's the same chart. It's the exact same chart. And we're starting to get a lot of chop down here in euro dollar on the downside. I am not as bullish dollar as I've been. we did the intermarket analysis over here in crude oil. Remember, crude oil is off the lows from overnight, where S&P is through the lows. So the stock market is not being driven right now by euro weakness or crude oil weakness, which, as you can see, they're the same. It's the same market. It's the same wave count. I mean, trying to talk about getting meaning and understanding what's happening in the market. You know, when you kind of get this confirmation, it's the same chart. I mean, if you overlay them, they're right on top of each other. So euro's trading right with crude because crude's trading inverse to the dollar. Now, what's interesting, as I said, we're not getting stock market acknowledging that crude has not made a new low. Euro dollar has not made a new low, meaning the US dollar has not made a new high. So I'm a little cautious. And then on top of that, if you get inside of this structure, if I go down to like a 1 hour, this is real choppy. I don't know what that is. It looks like a diagonal. I don't know what it is. It's definitely not a clean impulsive pattern. So we've lost the urgency to the downside in the dollar. That's what that wave structure tells us. Plus, we've got crude off the lows. So you've got Elliott Wave on one side, and you've got crude oil on the other side. Elliott Wave on one side, Intermarket Analysis the other side, saying, hold on, this dollar buying story, crude oil selling story is getting tired. Stocks don't know it yet. Stocks are like... stocks are 10th man on the deal team, kind of last man to know, to screw up Gordon Gekko's quote. So I mean that happens time and time again. But you know, they could be trading just on poor economic data like we saw in retail sales. Okay, so we'll see what happens there. Crude oil, as I said, choppy. Don't know what this is. We are looking for one more new low if we haven't already seen the low. And I don't think it's going to be a magnificent reversal. I'm just looking for a way forward back into the mid-50s, and then I do think we break down for a test into the 30s. Okay. Got to keep myself organized. Okay, so that's crude. How you guys doing? Everybody all right? Have I lost everybody? Just make sure. We hit you hard here, guys. Just want to make sure everyone's good and confused. All right, copper. Copper is the latest commodity crash du jour. Where's my coffee? We should probably take a look at coffee, other soft commodities, as I'm pounding coffee. There's going to be a lot of this today. I was up till 2 a.m. working on presentations and market analysis and watching dollar yen break down. And who needs sleep? Sleep when you're dead, right? Okay, so copper. This is a cool chart. It is a custom chart from Fed by TradeStation. It is a continuous contract that has been kind of the continuous aspect. The rolling and the adjustments that are made from each contract expiration have been taken out. So it's a pure price chart of copper. If you don't do that, your lows are going to be significantly different. If you do the continuous contract, you're going to see a low at like 159 back here in December 2008. The actual low is like 125. Okay, so if you want help with that, just email me and let me know if you're interested. I mean, when you're doing longer term analysis like that, that's super important. Okay, so from 2001, we have a 1, 2, 3, and working on a 4 touch point uptrend line inside of 50% retracement. Okay, so copper has broken down pretty good, and the whole world's been like, oh my God, copper's getting crushed. If you look at this 3-hour chart and say, wow, it's getting hammered. Well, we haven't seen anything yet. We haven't even broken uptrend support yet. So I mean, that just goes to show how significant of a move this is becoming. I mean, this is on par with the credit crisis. I mean, that's how far commodities dropped. So we have uptrend support at around 235 to 238 on top of the 50% price retracement of I don't know how to show. No, I don't know how to show. I don't usually use these. Interesting. I don't know how to show the price. Anyways, it is 2.42 area. So we have some pretty good support that is about to be tested in copper. So I think we have lows to, or some setups to look at here. Let's take a look at a retracement of the big swing. Oh, got to bring 38% in there. We'll get rid of everything else. There we go, and there we go. Okay. So yeah, we haven't even touched the 38% retracement of the large rally from 2001 to 2011. So 38% is down here on top of the 618. So what that means is your trigger point is a break through this uptrend support, and then what you want to do is just target the first fib support zone right around 2.1 to 2.07. Okay, so how do you trade this? There's an ETF for that. So it's like the oh shoot, I gotta pull in JJC. There's an ETF for everything. I have to define this. Hold on. Define, and if you guys ever do this, have a problem, can't pull up a symbol. You go like here. You go define. Put in your symbol. Copy. Copy. Copy connections. Here's, I want to, if Tony's here, Tony, I didn't make you a presenter. I apologize about that. Tony, if you're here, hit me on Google Chat if you want to talk about, because we have some cool new features in MotiveWave. Okay, there is a new, oops, I got an email from Tony. Sorry, buddy. Didn't make you a presenter. Sorry about that. Come on in, and I will make you presenter. All right, guys, sorry about that. I'm done. Presenter. Okay, so we have some cool new functions in MotiveWave on the new release. Multi-broker support, which is awesome. So I have my eSignal account, TD Ameritrade, TradeStation. I got to put my IB account in there. So basically, you can feed this MotiveWave with a variety of different brokers and quote providers. So pretty awesome. So just do that. I'll just do eSignal, eSignal, and eSignal for this JJC. I hit OK, and I hit cancel. And then if I just go JJC, it should now be available to me. There it is. Perfect. Okay, and we'll just let that price data load. So JJC is an ETF that tracks the price of copper extremely well, and there's JJC right there. So we could actually just do the analysis there as well. It's not going to let me go back as far as the copper futures itself, but I'll go back and line up the exact prices to figure out what the breakdown levels are. So I do think copper wants to get out and test those significant levels. So I'll be working that out here today. So I don't want to waste any more time on that one, but JJC is looking to be a pretty good one. Okay, gold is 1240 bid, finally. Okay, I think gold is breaking out. I've been on the show a lot talking about this uptrend support. It's something that you would not see unless you use semi-log scale, and a lot of people haven't seen it and they've missed it, because if you go to semi-log, you're going to see technical support levels that others won't see. Okay, so let me just kind of, there we go. All right, so if you go to semi-log scale, and the way I did that is right-click chart settings, semi-log. If you just do a trendline support from April 2003, July 2005, October 2008, we are above trendline support, which if you did this, if you got off of semi-log, you wouldn't see that trendline support. Okay, it would look something like this. If you were to connect the lows, it'd be like a touch point there, touch point there. You wouldn't see trendline support until like 1,000 in gold. So, when you're doing longer term analysis like that, it's important to use semi-log because it will change where your technical levels come in. So coming down to that low, we have what I see as a 5-wave move into trendline support. And the market was highly bearish gold when we broke through that 1180 level, and we talked about it on CNBC like for 2 weeks straight. And I kept saying, guys, there's two things going on here with gold. One, we're above the March 2008 highs of 1108, and two, we are above uptrend support from 2003. So until we break those levels, there's no reason to get bearish. And I tried to get long twice. I think we're probably down small on it, on the trade. We with clients, we've tried to get long twice. It's been a very choppy maneuver. I actually got long a little bit of GLD last night, closed it, and here we are right back at the highs. So what I think's happening is this completes a 5-wave move in A from the top in gold, and we should get a 3-wave move back in B. And B wave traditionally goes to a 50% retracement, and that's at 1485. So trust me, I'd love to see gold through 1,000. I'd love to see gold get hammered, but you got to trade what you see, not what you think. And what I see is a completed 5-wave move into technical support. We're trying to break above 1240, and this stock market breakdown that we might finally have today could be the catalyst to push us through 1240. So let's go down to the intraday. And what we've seen from the initial test of the lows here, make sure everything's lined up, got to be neat. Snap in, there we go. And what you got to do, guys, is just got to kind of left click and hold and just make sure MotiveWave drops them at the swing point low. And when it does, it'll kind of pick it up and it'll line everything up for you. Okay, so the initial move higher, I see it as a diagonal. 1, 2, 3, 4, 5, and then we did a crazy ABC down right to the 618 retracement. I think we tried to buy like here, watched it go for us, and then we got stopped out at break even, and then it went. And then I tried to buy a little bit more 2 nights ago, made a little bit money out, but I'm looking for the full kind of release and break through 1240 to take us in 5 waves up towards 1320 area. So gold's looking good. The way you can do this one is with the GLD, and what I just did there, and this is how I overlay ETFs on the underlying. Add study, instrument overlay, and then this dialog box pops up, GLD, and then we get down to orange, whatever, thicken them up, hit create. And then what I do is I just kind of overlay them and then just line them up and figure out what the levels are in the GLD. So I just kind of hold them and just put them right on top of each other. This isn't science. This is horseshoes and hand grenades. Close is good enough. That's pretty good right there. So what we're looking for on the right scale is we're looking for a move from 1240 up towards that 1.618, which is your key wave 3 level at 1300. So we're looking to go from 1240 to 1300. So just look over here on the left side over GLD. 118.50 up to 124. Okay, so if you wanted to do a call spread, you could do like you could buy like a 119, 124 call spread. The timing of that move, time analysis 3v1. And let's not do that one. Let's actually use this time. Time analysis 3v1. That's what I like up there. 100% 3v1 is February 3rd. One day after my birthday. How about that? So, to give yourself enough time for this move and possibly participate in wave 3, wave 4, and wave 5, I'd probably look to do this out in February. Give yourself a month on this to do, as I said, the 119, 124 call spread in Feb. Okay, so we'll leave it there, guys. You guys are quiet today. I don't know if I was just on a tear, on a roll, or delirious from being up late last night. But any questions on there? Any comments? Let me know. As I said, the new MotiveWave version is out, and it's pretty awesome. So just go to MotiveWave.com. And Tony's been working on this forever, and I've been working on the beta version here for a long time, and with him, and it's pretty awesome. So got a new look, new features. Those of you who are active with Elliott, they've got the hotkey in there, which I asked them for. You just hit Control up arrow, it hides the different degrees so you can show more or less. Pretty awesome. Multi-broker support, stuff like that. I didn't make Tony a presenter, so that's my fault. But just go over to MotiveWave.com, download, and the new version 4.0 is released. And I know the last one hasn't been released till since October, and he's usually updating stuff every week. So this has been a big release. So go ahead and check that out. And if you don't have MotiveWave yet, obviously it's a pretty rocking piece of software for Elliott and Fib and Intermarket Analysis and anything else you like to do. And you can aggregate different quote sources as I showed you. So head over to MotiveWave, tell them Todd sent you, and Tony and the crew will take care of you. All right, guys, I hope that helps. Good luck. And subscribers, I'll see you guys in the room in 2 minutes. See you guys next week.